Chapter 6 deals with inventory. Inventory is often one of the biggest current assets on a company's balance sheet. Consequently, the accounting for inventory is one of the most important parts of learning accounting. The learning objectives for this chapter are outlined here. In the last chapter, we talked about merchandising companies without actually calling it that. This slide contrasts a merchandiser with a service business. We talked about an account called cost of goods sold last time. This chapter will give you a better understanding of that account. Cost of goods sold appears on the income statement and inventory on the balance sheet. When a sale is made, the company can calculate how much gross profit before other expenses was made by looking at what the item, the inventory, cost of goods sold, and subtracting that from the sales price. The cost of inventory is recorded on the balance sheet in the asset account. The expense of that inventory is recorded on the income statement when the inventory is sold. That doesn't even sound like it makes sense, does it? Well, remember the matching principle? We're basically adjusting the inventory account to show what's been sold, but instead of calling it inventory expense, we call it cost of goods sold. This slide explains it a little better. The amount recorded in the inventory account is equal to the number of units of whatever product is being sold that are on hand times the cost of each one. What should be included in inventory? A physical count is normally taken once a year to determine the accuracy of the accounting records. Anything on consignment, if it's yours, you count it. If it's not, you don't. If goods are in transit, it depends on the shipping terms. FOB, which means freight on board, shipping point. As soon as the stuff gets put on the truck, it belongs to the buyer and would be counted as part of their inventory. FOB destination means it doesn't belong to the buyer until it arrives at the store and is taken off the truck at its destination. One of the things companies have to determine is what costs belong in ending inventory if prices change throughout the year and what costs go into cost of goods sold.